What's the institution that controls the money flow? When exactly to print out more dollar bills? How much of it should be, just running around in the country? How do they even know how much money to inject into the economy or what kind of rate to even charge us at the end of the day? This institution can even determine how long we take to pay our mortgage. Are you interested in learning who they are? Just keep on watching. Hello everyone, and welcome back to another episode at Nova Rice Invest. For those who are tuning in for the first time, this is your channel for real estate education. So today we're going to learn a little bit about history and economics, right? Those two truly go hand in hand, and it's going to help you understand what's going on today and also help you to make better decisions, financial decisions going forward. So without further ado, let's just jump straight into my iPad. So here we are, and the first thing we're going to do is to go down on memory lane. So we have memory lane right here, and it all started back in 1907. So what was the big deal with 1907? And you might have or may not heard of the Panic of 1907. And this was kind of like a mini depression, but it was very, very intense, and it only lasted approximately 7 months. You don't hear much about it because most of the studies have been done in the Great Depression that happened for decades, but this one in particular was very, very short-lived, right? And at the time, what happened was that the government did not like to mingle with anything that involved finances, right? They always thought that it was best to keep things separated, so to speak. So the government should be focusing only on government stuff, and whoever dealt with finances should be solely someone who specializes in finances. So that particularly belonged more so to the bankers. And because of that, there was only one individual that pretty much took on the role of managing the economy at the time. And this person was J. Pierpont Morgan. And I'm sure you've heard about him over and over again, even up to today. 100 years plus after 1907, his institution is still standing, and it's standing very strong. So J. Pierpont Morgan is the original, the one and only founder of JP Morgan. So originally the bank was only named JP Morgan, but it wasn't until the year 2000 that they merged with Chase Manhattan. And you know about JP Morgan because you see Chase locations pretty much all over the US. So the Panic of 1907 was a very bitter experience for JP Morgan. At that point in time, he's already outlived or survived tons and tons of roller coasters in terms of finances and the ups and downs in the economy. And he said to himself, look, I'm getting old. I don't want to deal with this anymore. I'm about to retire, and all I want to do is just to simply enjoy my life, looking for nice art, and then just live my life without the added stress of the ups and downs of the economy. But before he went on to do that, he first needed to put a team in place that could replace him and take on that role, so that he or the economy itself didn't have to deal with the madness and the craziness. And just so you know, JP Morgan was not the only one who thought that was necessary. Even before his time, there were multiple attempts to create an institution that will help govern the economy and just simply keep things very well maintained. So before 1907, there were plenty of other institutions. So the first institution was created in 1791 by Alexander Hamilton. And I'm sure, and if you're a Broadway fan, I'm sure you've heard of the show Hamilton. It's been sold out for, and I don't know, since it first was launched. And that's the story about his life and what he did, right? So Alexander Hamilton founded the first central bank of the US, but Unfortunately, that was somewhat short-lived. They didn't have the right expertise in place, and the bank just simply ceased to exist in 1811, right? So that was the first attempt of the US government to actually put something together and help deal with the madness, right? But then they thought, you know what, I don't know, maybe that was the first time, and you never do things right the first time because you're inexperienced. Maybe this time around we'll do better. So in 1816, the second bank of the US, of the United States, was also created. That, just like the first central bank, was not being managed properly. Everything was poorly executed. And by 1836, the bank just ceased to exist as well. And after that, the government just simply said, you know what, we don't want to deal with this anymore. We'll just, leave things to where they belong, finances to bankers, and we'll just deal with domestic policy and anything that involves politics. So back to 1907, JP Morgan already knew this, but he was not willing to let something like this happen. And he set up a team, a group of experts that started putting together a series of laws, regulations, whatever you want to name it. And it wasn't until 1913 that President Woodrow Wilson signed the Federal Reserve Act that allowed or gave birth to what is today known as the Federal Reserve System. And for those who are curious, here's the map of the Federal Reserve System. So it's composed of 12 districts. You get the Federal Reserve Bank of Boston, the Federal Reserve Bank of New York, Philadelphia, and all of these 12 districts is actually controlled by the Board of Governors, just like that blue box that you see right there with the star in the middle. So now you're probably wondering, okay, that's a great history class, that's awesome, but I still don't understand, what does it have to do with me? Like, it sounds like it's such a grandiose institution, and it's just so big, and at the same time it seems to be so far away from me. Usually bankers have to deal with them, but what does it have to do with me as the individual? And so just to share a little bit more with you, so the Fed has something that it's called the dual mandate. And what does the dual mandate do? They maximize employment, and they also regulate interest rates. And you're probably wondering, how does the Fed regulate employment? Very easy. So think of it this way. Let's just use today as an example, right? So we're in the middle of a pandemic. You hear left and right about businesses closing, people being laid off. And I mean, that's expected, right? Businesses are closing not because they want to close, but because it was a government mandate. The government wanted to stop the virus from spreading, and therefore all these establishments, the restaurants, they needed to close down. But what happens when you close a business? That means income stops coming, but the operating expenses are still there. You still have to pay your rent, you still have to pay your utilities, you still have to pay your employees. But with your business closed and no income coming in, you have no other choice but to let your employees go, right? So what did the Fed do? Because you're probably wondering, well, do they have the power to tell the government what to do and vice versa? No, they just simply push money out into the economy. So how does the Fed does it, right? You're probably wondering, because they're not really, a government. Well, they are a quasi-government institution, but the way they do it is that they use a method called quantitative easing, or QE for short. And that's just simply a fancy term of saying I'm injecting money into this economy. So the way they inject money into the economy is by buying government bonds, they buy corporate bonds, and for you as an individual, they just simply provide you with a stimulus, right? So you get the stimulus money, you get the unemployment. So they have the power to maximize employment through those methods, because if there is money flowing into the economy, that means business and corporations, they can continue to run, and therefore there's no need for them to actually having to lay off anybody, right? The goal is to make sure that everything is running properly. So that's one side of the equation. And for those who are business owners who are watching this episode right now, you probably at some point wanted to take advantage of the SBA loans, right? Which are part of the CARES Act. and you were at some point incentivized to take those loans from the SBA. So what happens when you want to take advantage of those loans? It's not like you as an individual can just simply walk up to the Fed and knock on their door and say, hey, I'm a business owner, would you loan me some money? So the Fed cannot do that. So the way they do it is that they take that money and they loan it to the banks, the institutions, and the banks are the ones who have the power to in fact loan you any money. So their role to regulate interest rates comes here, right? So at the bank, what do you think the bank want to do? They want to make money, right? At the end of the day, they want to charge as much interest as they can because the banks are in this business to make money. But you as an individual, you are already hesitant just by thinking about the word debt. Okay, not only I need to worry about borrowing money, I also have to pay them interest rate. So the Fed, it's here to find that middle point between you and the banks. The banks, they need to be incentivized with enough interest rates so that they're even willing to loan you that money. And you as an individual, you need to also be incentivized with a good interest rate, because if it's too high, then that will make it very difficult for you to even want to take that loan. But in a way, you kind of need to, because you want to make sure your business doesn't fail because of what's happening with the pandemic. So their job, once again, is to find that middle spot that works out best for everybody. That's why you see them all over the news. You hear about Bernanke from back in 2008. Eventually you heard about Janet Yellen, you heard about Powell now talking about the interest rate and how they decide to keep things low because they want to maximize their dual mandate. They want to ensure that there's employment in the economy, that people are as employed as possible, and at the same time that the interest rate it's somewhat decent. That's why you hear the term cheap money. A lot of people are talking about cheap money because the rates are so low that it is almost very cheap to borrow the same money. Nobody lends money unless they can get some interest in return. But here we're talking about rates that are at the historical low in comparison to the 80s or the 90s. And now that you know this, you're probably saying, okay, I understand how does that impact me at the personal level, but I am still not quite sure how does that impact the world. Like, what does the Fed, a US institution, have to do anything with the rest of the world? And it has a lot to do with it. So for that, we're going to go down a memory lane again. So before 1971, right, the dynamic with money happened this way. So you have your gold bar right here, and you have the US dollar, and here you have all the other currencies from around the world. So we're talking about euros, pesos, the yuan, you name it, right? And the dynamic worked as follows. So the US dollar was backed by the gold, and its value was directly correlated to the value of the gold. But the rest of the currencies around the world, their value was based on the US dollar. Yes, so if the US dollar went up, the other currencies will go up. But at the same time, they will be worth just as much as the dollar because this was the dynamic. But then after 1971, after President Nixon decided to take the US dollar out of the gold standard, right? So what happened was that now, because the dollar is out of the equation, you see the US dollar floating. So there's nothing that's backing up the value of it. So it's just a piece of paper that has a value that people give to it. And the value can be manipulated. And just like any rules in the economy, if you have too much of something, the prices go down. If you have very little of something, the prices go up. That's why gold is so expensive, because the amount of quantity available in the world of gold in comparison to silver is actually very low. That's why you see gold at such a high price and you see silver at such a low price compared to the gold. So it's the same dynamic with the currency. Now with all these stimulus packages, we're talking about trillions and trillions of dollars being printed out every single day. What happens to the dollar is that it's going to start devaluating. It's going to start lowering its value. And what happens when the dollar goes down in value? That means that the other currencies around the world are also going to lower their value because they are backed by the US dollar. So this whole dynamic is being impacted by one single institution, just as powerful as the Federal Reserve System. So I would love to hear what you think about this. Do you agree with what the Fed is doing? Do you think they should continue to do what they do, that they're doing a great job? Or do you think that they should just simply stick their noses elsewhere and just let the economy be just the way it was before in history? So I would love to hear your comments, and don't forget to hit the like button right here, and don't forget to check out this episode right here. That's going to help you complement everything you just learned today. Take care. Bye-bye.